Good morning, welcome to this update on Friday the 1st of July from Phoenix Blue. I'm Tom Colley and I'll take you through the news and the markets this morning. So here we are, the end of the first week following the shock Brexit vote in the UK. We've seen markets recover to a certain extent, but we've also seen certainly a quiet week on FX. There's a great deal of uncertainty about what will happen. The reason being that until the UK activates Article 50, which is the start of a 2-year countdown to leaving the EU and to undertake the negotiation process, nothing or very little is really known about what will or might happen. Adding to that the political uncertainty in the UK, where effectively we don't have a prime minister who is in a position to activate Article 50 until early to mid-September. We're going to have what I'm sure is a concerted period over the next couple of months in the markets, which are often the quietest time anyway through the summer months. We may see inactivity unless we see some news filtering through or some other event. Right, first off, let's go and have a look at the news from yesterday and today. We had negative current account figures in on the pound first thing yesterday morning. Obviously these figures predate Brexit but aren't going to filter in well, because anything we see negative that was based on the previous scenario, which was, let's say, assumption that we would stay in the EU, is only going to drive fears to a greater level. We also had Canadian GDP coming in at expectation, unemployment claims from the States coming in as expected. We then had a significant speech from Mark Carney, the Bank of England governor. He said that, in his opinion, the UK would need further stimulus measures over the summer, or during the summer, or to get through the summer, presumably talking about this window of time before we get a new Prime Minister, etc. Now that could be one of two things. We could be looking at a reduction in interest rates. UK interest rates are only at 0.5%, but in a world where negative interest rates exist, that makes it the third highest level worldwide in the significant countries or the significant currencies. So we could see a 25-point cut in that as soon as next month, or as soon as the 14th of this month, I think it is, when that figures in. But probably more likely we'll see a return to quantitative easing in terms of, let's call it, printing money to retain liquidity in the markets through the quieter summer period. We also had a speech last night, which from FOMC member Bullard. The speech was actually in the UK. Bullard's known for being a hawk, a rate riser in the States. What came out of that was his opinion on how the US economy was going to move forward was little changed by Brexit. He saw it as a low-rate future with relatively slow growth but relatively high employment, so somewhat of a status quo. But he seemed to be suggesting that further rate rises this year were unlikely. We also have in November the US presidential elections, so I would suggest we're not going to see any rate moves prior to that, or immediately prior to that, let's say in October/November, because for fear of those appearing to be political moves, which is the normal scenario which central banks will take into an election of that nature. Now, overnight we had some significant news out of China with the manufacturing PMI figures. The standard manufacturing PMI are government figures, conveniently at 50, 50 being the point at which or the midpoint between contraction and an expansion. This figure's conveniently been hovering around that level for several months. The Cakesim, which is a private organisation, we can see really negative numbers coming out on that. We'll look at that further in a minute when we look at the dollar yuan exchange rate. In terms of what we've got to look forward to news-wise today, we've got manufacturing PMI at 930 for the UK. Obviously, that's same scenario exists for that. Those will be figures pre-Brexit, so anything that is negative could be perceived as being more negative when you add Brexit in on top. With a bank holiday in Canada today, worth bearing in mind if you're looking at trading that market, and then we have manufacturing PMI from the States at 3 p.m. Heads up for next week. Monday is the 4th of July. Huge bank holiday in the States. That may mean that we see extra or a higher degree of profit taking today pre the holiday, and we'll obviously see a great lack of liquidity in the US session on Monday. So be aware of that when you're analysing over the weekend, and take that into account. And maybe if you are looking at some trades, sit out on Monday and look to Tuesday when the market is picking up in liquidity again. Okay, the Shanghai Composite here. Well, we had that negative manufacturing information from China. Hasn't had a huge effect on the market. We're still at this 2940 level. Not going to draw too much from that. Like the standard manufacturing figure, there's an element of government manipulation in this market, so we will just keep our eye on that. More significantly, the Chinese yuan. We mentioned this earlier when we were talking about the manufacturing numbers. In August of last year, in the run-up to August, we had some really, really poor manufacturing numbers out of China. That resulted in this massive devaluation that I've marked here, that led to a big sell-off in equities. This is the S&P weekly, and that's the same beginning of August scenario that we saw a huge move down. That certainly before Christmas was usually, or before we saw that again after Christmas, was extremely or was a new low for a concerted period of time. What we then saw is the post December drop in equities, potentially driven by a more organic devaluing of the yuan against the US dollar. We're now clearly at this critical level here. That level pre-Brexit was certainly, there was agreement within the G7 or to maintain that level and not to devalue further. I think in that scenario all bets are off following Brexit. We've got negative numbers out of China. I'll be watching this chart a lot more closely going forward. If we can see a break of these highs or a close above these closes here or something, that might be a signal for equities to be on the way down again. Even though we've seen a bullish move this week, a recovery following the Brexit vote, which we'll also talk about in a minute. Over on the Nikkei, very much we've had a week of recovery from the fallout from Brexit. Reflected on the US dollar JPY yen exchange rate, we've had a weakening of the yen following that huge strengthening move, the intervention that we believe we saw at this level here. Over on the dollar, again we've had a quiet week, no real strength or weakness in the US dollar. We are still bullish this market. We are waiting for it to break out above this 96.70 sort of level here before heading north, upwards towards 100 potentially, as long as the US retains its position as the only strong economy, and I say strong in inverted commas, or the single strongish economy worldwide. We would still anticipate that we'll see dollar strength and weakness with most of the other currencies that we are looking to devalue in order to generate growth and inflation. Look at the pound to see what we've done this week following the Brexit vote. Well, we've just consolidated around the lower levels. We haven't seen a pull back in this market, or to be fair, in the euro of the same degree we've seen elsewhere. We had a bearish day yesterday based on the comments from Mark Carney at the Bank of England about further stimulus, QE or rate reductions, whichever that might be. Over on the S&P, well, we've had a very bullish week since Monday. That's Tuesday, Wednesday, Thursday. A bullish open today. Can potentially see recovery right back up to these pre-Brexit levels here. But what's interesting here is this, in principle, would normally be a risk-off scenario. Sorry, a risk-on scenario, not risk-off. Risk-on in that the market is returning to risk. Its appetite for risk in equities is increasing. But if we go over and look at a safe haven, we'd expect there to be the opposite move in this, and a risk-on scenario. We would expect to see the safe havens falling away. Now, we obviously fell away from the peak of Brexit, but what we've actually seen is since we pulled back through this week, we are actually bullish in this market. So we haven't got a risk-on scenario. We've got a recovery on equities that's not reflected by a broad confidence in all the markets. Otherwise, we would have seen gold, and I'll show you silver in a moment, breaking down to these sort of levels. This is gold weekly. Put that in. There's a very significant trend line here, which is this one that comes through here. If we see a break above that, then I think we're really going to see that run to safe havens. We have a commitment of traders extreme signal here, which suggests that the market is reaching a top, is at a top, and we're looking to the short side, certainly on a pullback. Having said that, in the current market, the current environment, quite possibly that signal could be ignored. If we get a break above that high, above that trend line, then we're going to be looking for every opportunity to buy on every dip on the way up there. We have already seen a significantly bullish year, with price up virtually 25% on the year so far in gold. But that's been our long-term strategy from the beginning of the year. We've had a period of consolidation through this period here since we had the real bullish move there. But yes, over to silver. Yesterday, the last 2 days, has had two really bullish days on silver. I've mentioned before that silver is seasonal through July, seasonal strength through July. It's seasonally strong relative to gold through July. We've broken a significant level here. This is a weekly level that goes right the way back, and is also a fib level of the entire market move from the early part of the 2000s. You'll see we've got an entry in here around the 1850 area. We're looking for a pullback into that to take that market long. Again, in this market, we have a COT extreme signal, but those last 2 days movements, from our perspective, means that has been ignored. So we will change our bias until the next significant level, which we see up here around the 2150s. So potentially a nice big move in there. So look for a pullback, if not today, certainly through the early part of next week, to take us up to those levels as we get that run to the safe havens. Finally, just to show you a market we were in yesterday, we were talking about this market. We've been in from this level here. We scaled in on at this sort of level with a second entry. We were a little, or I was a little concerned about the entry yesterday, in that we had an open which was way above any significant or way between the highs and lows of the previous day. I mentioned that you wouldn't normally see that on FX. After I'd made the video, I remembered and realised that basically we were at the end of a futures month, so we were rolling into the new July month, and from that perspective, any chart that is a continuous chart will have some sort of correction as it moves from one futures month to another. Now, if you want to learn more about that really is part of our COT analysis. And if you would like to learn more about that, the thing to do is get in touch with us. Either visit the website, go to or email us at info@phoenixblue.co.uk. We do have a 4-hour free trading session coming up in London on the 19th of July. If you'd like to come and trade with us, learn from us, have a question and answer session, go to the website, the events section, and register your interest there, and we'll confirm by email to you. Or again, send us an email direct to info@phoenixblue.co.uk. Okay, and then comes the end of another trading week. It's been another interesting one following the Brexit. Have a great weekend. Do your analysis. Come back to the markets next week prepared. We anticipate still not having a great deal of interest in FX next week, but we will do our analysis, have a look at that, and see how we move forward. Okay, guys, thank you and goodbye.